Hi, everyone. Welcome to the Capital Raiser Show, Season 5, powered by the Family Office Club. I'm your new host, Weston Walker, and we interview only the best investment managers and entrepreneurs. Shout out to our sponsors, the Family Office Club, Capitalist Pro, and Invest Next. Today we have two guests. We have Judd Dunning and Ryan Billings. Judd is the president of DWG Capital Partners, and Ryan is investor relations. They have about $80 million of triple net leaseback properties under management, and they're currently raising a $100 million fund. And Judd has previously been in capital markets brokerage, where he and his team closed over $1 billion in transactions the past 24 months. So, Ryan and Judd, welcome to the show.
Yeah, thank you, Weston. Thanks for having us, man.
Absolutely, Westy. We're looking forward to meeting you. You're a dynamic young talent out there. So thanks for having us on.
Awesome. Well, thank you guys. Let's get a little bit into your background, Judd, first to start us off, and then you can talk more about the $100 million fund that you're raising.
Absolutely. Fourth generation American real estate, fun story. If you want to go back to the roots, I think that's always interesting, right? We came over from England, we came from Cuba and fleeing repression, came from Poland. So our family was on the East Coast for a long time, and my granddad's dad was working on the Suez Canal when passed away, and he ended up being a ditch digger. Little kid, fifth grade, had to support himself, and by the time he was older, he was the top GI Bill builder for most of southern Florida, and he owned 76 gas stations down the coast that got taken in antitrust because he would build a gas station behind everything. Came from nothing, fifth grade education, and then built most of Miami Shores, et cetera. So that was my granddad, kind of in my life as a young man. I grew up, they moved up to Highlands, North Carolina, which is now Aspen of North Carolina. Technically, Ryan's from North Carolina as well, as wild. And we, Floridians and New Yorkers, we went there. So I'm an East Coast family. And then my dad was like a land trader. He would make money by putting me in his car, and all I remember is driving land as a kid with he'd have a bottle of scotch and a shotgun with some shells, and I'm like, "What are we doing?" He's like, "It's going to be fun." I'd be driving land for all my childhood, so it was always. And I said to my dad, I said, "How'd you make money in America?" And he said, horse sense, son. I don't know. I was like, "I don't really know how to do horse sense, Dad." So my uncle was also DWG is a family office. So Dunning is that side, and on the Whitner side, from an age of 15, my uncle was on his own, and he ended up 42 years in Merrill Lynch, and he created middle markets in the United States. So a great story is like the institutional was drying up in the early 80s, and retail had this level. So he created the middle markets for all the stock market companies. He got a full page in there. So I ended up, and I was going to go and follow those two paths. Came to Hollywood, ended up getting scouted off the street. I'll be who I am. And then I ended up from a soap opera into film finance. Got over to Keller Williams Commercial 20 years ago when they were just good to Starbucks roll up. And I was rookie of the year out of 200 people because somebody said, first guy in, last guy out. And there you go. And I started syndicating malls like movies because I didn't know how to sell real estate. And so, Publix was the star. The George Clooney was Walgreens, and all these Jewish gentlemen and Southern gentlemen. I started doing JVs, and at the moment I was kind of breaking all the blue sky laws. They're like, "What are you doing?" I'm like, "I don't know." And I had like 5 LoopNet profiles. I was just trying to do business. It was when LoopNet was the Wild West, and we did well. And so I got scouted, went to Sperry Van Ness during the Guardian Sperry roll up. And started doing groups of Home Depots and groups of Wendy's and KFCs and malls across the United States. And I got comfortable in single tenant across the United States. So then I got scouted over to Newmark before they became 5th in the world. And I rode that all the way up to the IPO last few years. And I went in there and I opened the capital markets division for West at Los Angeles. And we would start doing like 16 different assets across the United States for banks. We'd be solving issues. And they merged with ARA at the time. So as a result, I've done about 15,000 multifamily units. But I was also doing a lot of JV, a lot of debt, a lot of bifurcations, et cetera, solving problems nationwide. As a result, turned 50, gave myself 50% raise. I'm 58. And so I've had two distinct careers. And we opened up our own shop. And, when you leave the institutions, you don't know how you're going to do. And we sold Sony Studios for 160 million bucks. It was a deal of the year award on the Los Angeles Business Journal. We established the company. We went and did some large projects in Malibu, $1 billion of other projects, and made that transition. And a few years ago, we were at that final point of like, where do we take all this cumulative knowledge? And we won a bunch of awards in that space. And so we said, it's time to no longer make Chase Bank or Goldman Sachs wealthy, but our friends and family. And so we pivoted, hopefully with my cumulative experience, and I'm just a conduit of service. I don't have any ego attached to real estate. It's a beautiful industry, which it gives us more time for nature, family, and God. That's what I think about cash flow in real estate, serve others. So we now we have about 300 or 400 investors, a couple family offices. We're up to 100 million AUM of industrial triple net sale leasebacks. So we find these American companies, we're in like 10 states. We find these American companies that are growth in the path of the distribution and logistics changes, the onshoring changes in the United States between 50 and 250,000. That's our niche. And that's what we do now. So we're up to 100 million. We have a $100 million fund now. So I hope that wasn't too verbose, but I think those of us that love real estate like to know like how you get to where you are and why.
Yeah, of course. And congrats on the transition from your brokerage to scaling this fund. Ryan, let's go into your background a little bit. You guys raised about $10 million in 3 days. Judd sent me that message. I was like, wow, that's incredible. So Ryan, give us a little bit about your background and how you got partnered with Judd and his team.
Yeah. I've worked across the private market space, both in venture capital, private credit, as a tech founder as well, which I've now exited those platforms. So found Judd. I knew the industrial sector. Data pointed to the strength, and ongoing strength and growth of the industrial sector. So I knew I wanted to be involved there. I've got some family involved in the industrial sector, so wanted to branch out of that and kind of carve my own path here. And I met Judd. We met in LA. Crazy enough, we grew up the area Judd grew up and the area I grew up are an hour apart. Very small towns in North Carolina, up in the Appalachian Mountains. So it's pretty cool. So I've worked in various sectors across the private markets, but definitely excited to be an industrial. Definitely exciting, dynamic market sector to be in. We've had a pretty hot couple weeks here. We've got some intros, some great groups of people, and have some capital flowing. I think people are seeing the growth of industrial demand. Is we're in a weird inflection point where demand is at an all-time high through onshoring. You've got cost of living rising in China and India. You've got freight costs going up, making these across seas yields a little tighter. Then we have the implementation of tariffs. Onshoring is no longer a buzzword, but a strategic initiative. We are in the right place, right time. We didn't have a crystal ball. We didn't see the future. Judd did not recognize the numbers and demand in industrial. We certainly didn't expect it to be this strong. So we are at this great market window where, we have, I wish we could take all the credit for the money we've raised, but I think we do have a great strategy with a company that is positioned to take advantage of this market window where demand's at an all-time high. And then strangely, cap rates are also really expanded. Typically the higher demand goes, the more compressed cap rates get. So we are at a really neat time and place here. And I think, obviously some credit to us because we work hard and we find great deals and we're very communicative with investors, but we have, ultimately we are in a, situated in a really great position to take advantage of this.
Awesome. Yeah. So Judd, let's go into what is actually a good deal for you guys. What are you looking at and how do you add value to these assets?
I say 10 cap and a 33% IRR. Like if you don't know that, then you're in the wrong business, right? When do you run or sprint, right? Because I'm a capital markets guy, so it's been fun for me. And I was so funny. I was with our staff this morning. I was like, listen, don't get stressed out. Unfortunately, I know how to do everything in real estate quite well. And I don't mean that as cocky. I've just done leasing, I've done office, I've done retail, I've done all these different deals. capital markets was solving every type of asset across the United States. And that's why we're agnostic on our states. We'll go anywhere and we'll look at any sector of business if everything makes sense. That's DWG Capital Partners. So to define with Ryan, and also Ryan, you forgot, Ryan had a private debt background at a pretty successful company here in town, Hillcrest. And he comes from a group of luminaries that happen to have about, his family has about a $5 billion fund. So he's, I picked some good talent here. So it's really great to have him along. And he's really come a long way with the company. So it's been a lot of fun. A great deal for us is an intersection between arbitrage and security that cash flows our investors for an excellent long-term hold, taking in all the intrinsic fundamentals of real estate, the intrinsic fundamentals of business, and the best of debt brought together in a structured finance formula to benefit all parties in place. And my dad said something really important that we always do. We're a high integrity shop. It's so easy if you just are a really honest service-based person and, high road no matter what, but never do a deal you wouldn't do on a handshake, the people, right? And always leave a little on the table for the other guy. So there's a fine line of sterile opportunism in American aggregation, accretive real estate, accretive PE, where if you get too profit focused, you can alienate the most important thing, which are the people. And in industrial sale leasebacks, the brokers, like every time we think of it this way, every time we do a deal, we not only prosper our investors, and this isn't pedantic for me, this makes it fun for me, but we feed a village, all the different types, the environmental people, the title, the escrow, the PR, the due diligence people, our investors, of course, the banks, we try to launch these teams of prosperity. So it's a deal that takes care of all parties in parity and fairness, but that we've created above market arbitrage between the cap rate, the debt, and the pro forma of the property to, hit what we call the nearly add value bucket. So where does capital strike today? Weston, I think, is really interesting, but how does it strike safely, right? So you always have the traditional core people with their, looking for like 5s and 6s and, maybe double digits, or they're just taking their dividend and that's it. You have the core plus people, and that's been difficult with debt. So a lot of people are making these investments work because they're building in reserves to compensate for all these Fed raises. So core and core plus, unless you're buying distressed core or core plus, right, has been a difficult sector. So capital's been tight and constrained. So what we do is we find these deals that we engineer so that we can do like a 7 to 8 current pay, because that's where a high net worth and family office will structure. So we think about the client's deal first. We look to what is a good deal. And then we, 8% pref is what we deliver. Most of our money still goes to our investors and partners. And then, a 17 to 22 IRR outcome. Everybody wants to make $1 back in 5 years or 3 years if you have a 33, right? And then the cap rate arbitrage usually has to be 150 to 200 basis points above the debt. So debt matters, but it doesn't, because the Fed is determinable, and it's 190 basis points over 19 to 21 months from the peak of every Fed hike. And if things go crazy, the Fed de-escalates as fast as it re-escalates. The Trump factor is tough. Yesterday in the Fed, there's a standoff politically for Trump for anything he does. And Jerome Powell is definitely sending that message. You're right. We're not politicized and we're not buying into the Trump stuff. So our deals are structured finance deals, good markets, replaceable rents if the tenant ever leaves, below replacement costs, good growth dynamics, industrial, path of growth, or strategically located with strong credit to protect the investors and us because I sign all the personal guarantees, and cash flow based. So if I may say one other thing, somebody asked me, is like, why are you buying this deal? Why are you buying this deal? In the sale leaseback, industrial sale leaseback space of structured finance, which is a very proprietary small pipeline, you can't get into it. It's like having a private banking relationship with a series of brokers and PE. It's not a normal product. You have to prove that you can perform, and you buy when the M&A transaction says we need to buy this business and roll up. You need to transact the real estate. So we don't really get to say, hey, we want to buy in Arkansas tomorrow. We get to say, oh, there's a deal happening in Missouri. There's a deal happening in North Carolina. And we are present as structured finance real estate guys to be there. So it's a mixture of timing and fundamentals and yield.
Yeah, well said.
Ryan, anything to add there?
Yeah, just just a concise line to add on top of that. Along like Judd said, we look for we try to hit that 8% cash flow, creating kind of income fund style yields with more dynamic upside. We call this the DWG value equation. What we're looking to do is buy logistically superior real estate. Logistical areas are growing very very strong. Naturally, you take an asset that sits within driving distance to a couple large metros, but for a better cost basis because they're not in a downtown Chicago, right? That's gonna be very expensive real estate, but you can buy real estate for great cost basis outside of these large metropolitan areas. You're seeing a lot of large firms, a lot of activity in these areas. So we try to have strong fundamental real estate there, covering all the real estate fundamentals that Judd was just covering. But ultimately, on top of that, we create value through long-term net leases. We're creating a 15 to 20-year bond-like asset that's going to have dependable cash flow, built-in rent increases, and then ultimately what we hope to see and what we can do to create some asymmetric upside, that nearly add value bucket, as Judd was saying, is hopefully we've analyzed this company well, analyzed their growth plan well. They can use that capital when they sell lease back. They sell us the real estate. They take that capital and they extinguish their debt and may hire key personnel, buy machinery, buy a bolt-on business. And what we're hoping to see is this business prosper either through its current growth strategy backed by private equity, or even sometimes in a best case scenario, we'll buy a member managed business. They'll use that capital to grow and kind of hit that threshold where they're now on the PE radar and they'll be rolled up. So when we look to sell that asset in 5 years and it was a $20 million revenue mom and pop, and it got rolled into a $5 billion private equity company, we've created some pretty significant credit enhancement and value upside, which is a neat way in these. We're not doing direct add value. We're buying the asset, and it's not our core strategy to buy an asset and remodel it. But we are able to see that kind of development style upside with through tenant credit enhancement.
Awesome. So besides the strategy you guys have put in place, I mean, what's been the number one or top strategies for raising capital for you guys? Because you're scaling rapidly, you're building out your team, and you're buying more assets. So what are the top strategies you have for raising capital?
I'm going to interject and go over to Ryan. So I'm gonna un-evergreen this podcast to just say that we invest in America. And there's an American Pope that just got elected. You see that in the background? Yeah. The first American Pope, Provost from Chicago. Interesting enough. Why we're on your podcast, Weston? So I want to memorialize the first American Pope.
Yeah.
It's hilarious.
So kind of cool. So listen, and I joke around, but like we really think of our partners as we talk about life. My dad said, "Talk about life first." So here we are talking about life first. You got to if one of your watchers is a fund and wants to work with us, it's personal and it'd be a lot of fun. We're definitely looking to capitalize our family offices. To be honest, it's interesting. We have been so busy. I'll talk about capital from this. We've been so busy doing our job, which is like November, December, January. We're closing like 6 or 7 deals because we have to pay attention right now to this moment. We have elevated cap rates for about another 6 to 18 months, right? And for those out there, there's a secret sauce. It's not easy to get in this field. I don't suggest that I have to personally guarantee everything work 24/7. But we've been so busy doing our job, closing capital, that most of our capital is coming from repeat relationships, people that know us and trust us. And I have a saying is if you can't sell on page, you can't sell on stage. So our cover to our investor memorandum says what we're going to deliver, the high points. Ryan and I work very carefully. Our decks repeat that information. But I've been around too is long enough to, if we say it in a senior advisory on that page, that's what we're going to deliver. Mm-hmm. And so people are really trusting it. They get the thumbnail and they're like, I'm in. They trust our reputation. They know that we have a credit team from institutionally underwriting everything behind us. They know that they have my experience. So our recent theory has been just momentum. I'd say Ryan is really doing a great job, like really getting to know everybody's preferences and timing. Capital in the high net worth space really works, I think, quarterly. Everybody's like, hey, I made this quarter and I need to deploy this. And the guys that are in this space that's gone from 10 to 26% of the nation, and we were talking yesterday, it's going to be even more in the democratized space. They make decisions on the weekends and nights. Orion's like, I've been working today 80 hours a week, Judd. Because we have, it is a lot of work, but we've got personal momentum. Beyond that, I'll pivot to you, Ryan. And then behind that, we are now starting to take meetings with family offices, which takes a little longer. And I've been a star maker. I've made some companies, $billion companies on my side. And now it's about having time for family offices to meet us personally. You know, we right now we've got 100 million AUM, 1.1 million square feet. Our last exit was 23% IRR. We have a lot of credit enhancement. And now we're just going out to family office lists and events, and sitting down with people and saying, you know, we'd like, you know, the fund, if it's 35 million on 100 million, it's about six to $10 million checks. We're looking for 4 or 5 companies, and we're starting to have those meetings. And the big goal with this is we want to do $500 million over this next few years, because we think that we're very clear on this. Actually, industrial's in its 4th inning, and I'd say multifamily's in its 8th. So there really is a great moment here. So to be honest, you know, we are now pivoting into this space, and glad to be here, Ryan.
Yeah. Yes. You know, honestly, I would, you know, as much as, you know, it would be cool, I guess, to say, you know, well, I'm actually just this super high level salesman. I'm taking people to these fancy dinners and closing deals. Honestly, it's purely customer service. That's our secret sauce, if you will. There's nothing too fancy about it. We do what we say, and we, you know, treat people's money, whether it's 50,000 or 5 million. We treat it as, you know, as it were my, you know, our own capital, my mother's capital, right? We're very, you know, very open. We talk to investors, and, you know, give them the pros and cons of every deal. We want people to understand what they're investing in, and, you know, we're highly responsive. You can, you know, if an LP reaches out at, you know, Saturday, Sunday, Monday, if I'm awake, then, you know, they're going to get a response promptly. So, you know, through building that trust and relationships, we've been fortunate to not, you know, we're getting into some events, and you know, we have, you know, things like this that we're going to certainly participate in, and we're happy to participate in. But we've been very fortunate by, you know, making our current LPs happy. They brought in friends, family, coworkers, and we've had kind of this natural expansion, you know, which, you know, it means a lot to us. I think that says a lot about, you know, the kind of culture and shop we run. So yeah, ultimately, you know, nothing special about our secret sauce, just good hard work, honesty and integrity, and you know, and building these relationships.
Awesome. Yeah, and customer service, like you said. So Judd, you said the $500 million fund in the next 5 years or such. Go into the future plans for the company and your vision for building out your team and expanding into the industrial space, which you already have a reputation in.
Yeah. So we're going to do it. I mean, it was great to, you know, we were just at Milken in Beverly Hills the other night, and, you know, it was great to be there with we hit our benchmark, you know, 100 million and it took a lot of time. So we were very happy, because I have to tell you, like the last 2 years between like COVID and the Fed, you know, Morgan Hauser said this great thing. He said, those of us that keep investing through the storm, consistently on principle, end up 30% ahead of other people who don't. And so I have, you know, a couple decades now of experience, and I look back 3 times, like I could be off the wheel. And I know that's what my partners want. I could be off the wheel if I kept buying. And, you know, I was conservative. So we really did strategically buy well. So it felt good to be at this benchmark, you know, and now we know we've really established, we've met all of our distributions, we haven't had any issues, and we built this over 329 debt at the very beginning to 715, and we've successfully navigated, you know, creating higher arbitrage and risk in that. So our thesis is proven. We haven't exited a lot because we've had a lot of credit enhancement. It's only been a couple of years to buy this amount, right? So we're in a cycle. But we think there'll be probably an accretive sale, an aggregated sale to PE. But you only want to sell these all these credit bonded industrial. You only sell them to that if it makes sense. 1031s are 37% of our exit strategy on this, and they can pay above market too. So it's a fine line. Do you single, sale off, et cetera? So I'm just telling you where the company is. We're looking at exits and refinances for the first time. Refinances are pretty exciting though, because if debt comes down like 5.25, and we were at like these numbers, the cash flow to our investors it's going to be superior, and we're already giving good yield. So if it's good real estate, don't sell too. I mean, everybody wants to be out 3.5, 3.57, but we wouldn't, and so do we. And we look for the IRR sensitivity exit. Where does it peak and why? How can we add value to get it out there quicker? We're building an expansion on a site right now that's going to boost the value, and then it'll give us a peak IRR window. So we're investment managers. But the company right now, that first 100 million is, some of it will hold, some of it will sell, some of it we've had enhancement, we're open. So we have the next 100 million. And why do you want to do a fund? A fund is very simple. It's diversification and velocity. So this is a unique time in the American industry and industrial. Liquid capital is really important. This sector doesn't have a lot of people in it because you have to personally guarantee everything to buy 100 million. I've got $60 million in universal debt. People ask us, do we have skin in the game? So we don't have skin, we have 2 arms and a leg. I would only do this sector with the amount of experience I have. It's definitely, and with institutional credit analysis on 3 points behind every deal we do. I mean, we pay $100,000 just doing credit analysis, analyst analysis, CPA analysis, visit the businesses. We're helping businesses expand, and then we're taking the real estate and they're becoming a single tenant. So a fund takes the single tenancy and diversifies the risk for all of our investors. So now there's 10 tenants in the apartment building, or 20 instead of 1. So it eliminates terminal risk, which we haven't had any of, but it's smart. Velocity is, love to buy as much as possible right now. We're going to buy 30 million right now, but we could buy, when the fund is funded, we could probably do like 100 pretty quickly. I think a few months because of our relationships. So velocity and timing. And then as you see cap rate compression, and I hope I'm answering this correctly because you're answering the theory that's behind it. So right before the Fed unwound, we were chasing like 8.5 caps that became Class A industrial. The first time in history went down to 5.5. Industrial hopscotched office, it hopscotched retail, and it came right up next to multifamily. Then it settled 9.3 average yields in multifamily, 9 in industrial. Now they've paralleled off as almost the 2 darlings of the industry. I was in the industry when industrial was 20% vacancy and 10 caps. Michael Hackman, who owns all these studios, multi-billion Goldman, he started, and I sold him a bunch of crappy industrial. It's a completely different world now with logistics, onshoring, everything Ryan was talking about. So in this window, now that you have all these variables in the 4th inning of industrial, cap rate compression was at 5.5 before, Fed unwind, logistics, tariffs, Biden's omnibus bills, and the lack of any kind of policy. I mean, money is green, not red or blue, but there was no fiscal policy that was driving optimism. So there's chaos right now in tariffs, but there's optimism, which is really positive, particularly for industrial onshoring. So now we go out with the fund, we buy another 100 million. We anticipate that, and Ryan will point this out often, at Store Capital, they talk about when you bond the lease, it becomes worth about 125 basis points lower. So an 8 cap is worth about a 7.5 cap because we created a sale leaseback. So you have the initial compression of the value of a bonded lease in a sale leaseback. And then you have compression happening in the market. So as rates drop, cap rates are going to compress. So the fund should buy 100 million right away. And if we get some good partners, the reason I use a 500 million, I think, a perfect world, it's a little bit bigger than we are right now. We should do it 4 more times. I think that would be a nice point of exposure that we could handle, about $500 million.
Awesome. Ryan?
Yeah. And I think just to add on to one thing Judd said there about our specific niche, we are in that, we buy assets from that 5 to 14 million range, which does enable us to get, some expanded cap rates, mostly because One, this strategy is a very, not to pat ourselves on, we have a fantastic team of very intelligent, analysts and guys here. We're fortunate to have, but it does take it's a very sophisticated business analysis. You're ultimately looking at an underlying your tenant. That's going to be a single tenant in this asset. It's got a dynamic business and a growth strategy. You've got sometimes a private equity partner. There's very dense lease negotiations. You're typically negotiating with multi-billion dollar, private equity firms. It's not for the, it's certainly a extremely, sophisticated strategy, but that keeps a lot of the smaller players out. Whereas, some of the other real estate strategies are easier to run with two or three guys, can keep their overhead tight. So a lot of the guys we're bidding against are very large REITs, very large firms. That makes the deals between 5 and 14 million not really worth their while. It's hard for a public firm, to come in and look at a $5 million real estate asset and put their whole team. They just don't have they have too much overhead to make that make sense for them. So we do have a little gap in the market here where a lot of these assets fly under the institutional radar. Enabling us to kind of carve out our special niche here and acquire these assets with a little less competition. That doesn't actually hurt us on the sale. We'll use that for negotiating leverage, but it doesn't hurt us on the exit because we can actually, though these large institutions are a potential buyer for us, though it's not really worth their time to buy a $5 million asset, but they'll certainly buy a portfolio of $5-10 million assets. We can package these into one portfolio and exchange these out to a larger institution. So and that's very attractive to them because typically our deals are better cash flowing and more lucrative than the deals they're competing on that are $30-40 million deals. So that's an interesting thing about our strategy and where we are. We've kept our overhead light, which means Judd and I do work a lot, but we've kept our overhead light, and that ultimately allows us to stay in this niche and create these nice. We're giving, even with the debt rate environment where it's at now, we're giving 8% current pays 30 days after close, right, to the penny. So, that's pretty attractive for LPs.
Always.
Yeah, sure.
No, I'm just saying, we're doing an 8 pref.
Yeah.
And we want to do that, but we don't know in the next few months. I mean, because we did, just to give Ryan,
but our
we
company
went down
average,
to a 6.75 to a 8, and I hope you don't mind me saying that. It's like it all depends on the debt arbitrage,
Sure.
but we generally are doing 7 to 8 current pays,
Yeah.
8 pref. Yes.
Of course, some of these assets were purchased in a lower debt cycle, but our average current pay across the portfolio, I think, is like 8.8% right now. So it's definitely strong.
Yeah,
Awesome.
we've definitely performed.
Yeah, so very interesting strategy and lessons for both fund managers and investors alike. So, Judd, how can investors or fund managers, possible partners, get in touch with you guys?
Oh, thank you so much. So dwgcapitalpartners.com, you'll see Ryan's information on there. dwgcapitalpartners.com, dwgcapitalpartners.com. Tony Robbins said, redundancy is master, redundancy is better. I always say that at work. Everyone's like, oh, no. But you can get a hold of us there. Ryan Billings is on our website. He is he leads our capital markets team, and then I hop on and we love to meet anybody and talk. And I'll say this. I'll throw this out there. If you want to invest in like an institutional shop, there's some great shops out there. There's like Mag Capital, some guys that we know really well. There's the big stores. We're a personal shop specializing, and those are great guys. But we're a personal shop, specializing in empowering American industry. And I'm patriotic. I think it's a great country. And I have a fascination. I just want to end up with this, with the American worker. I was just over in Italy for 3 weeks. I'm like, why is this country so great? But why is everybody so unhappy, stressed? And our GDP per person is amazing. There's all this stuff about tariffs going on right now. I mean, I've never said America's better than other people. We're extremely fortunate and blessed at this time in history, and our productivity is great. So our shop is focusing on the Midwest, the magical Midwest, the 50 to 250,000 square foot American industry. We're bundling those together. And it is an honor to watch a company go from 6 to 20 million or 50 to 400 million, and then watch them become the dominant person and bolt on and grow. And if that's the kind of investment you're interested in, that's our shop. And you can get a hold of us there. It'd be an honor and a pleasure to work with anybody. And as Ryan said, we treat our partners like it's our own money. It'd be an honor and pleasure. We appreciate you having us today, Weston.
Yeah,
Of
yeah. And
course.
just one thing to add on that, Weston, is the American manufacturing machine is you certainly these individuals that go in and work hard to create product for our country. The quality's fantastic. It's hard to outwork America, and that's what as the great one Warren Buffett says, never bet against America. So that's what our thesis, the core of our thesis is to not bet against America, but to bet with it and the people who are the backbone of our country.
Awesome. Yeah, and we will put those links in the description. So if you want to reach out to Ryan or Judd and DWG Capital, you can reach them there. So thank you for coming on, guys.
Yeah, thanks, Weston.
Thank you.